Twice in the last 15 years, once during COVID and before that during the 2008-11 crisis, corporate bond mutual funds were in a terrible spot. Corporates who had put their savings in mutual funds rushed to redeem them, and the mutual funds couldn't find any buyers. And the result was the investor suffered, got a very low price. To help during such calamities, SEBI has now launched the CDMDF, the Corporate Debt Market Development Fund, which was recently, of course, inaugurated by the Finance Minister. Now, how does the CDMDF work? The CDMDF fund is created with every debt mutual fund contributing initially 2% of the debt mutual fund AUM, excluding, of course, gilt and overnight funds. They are not included. At a time of crisis, this corpus can be leveraged, say, 4 to 5 times by taking loans from banks. Now, why would banks give loans to such a fund? Because the government has agreed to guarantee this fund up to 30,000 crore rupees. Now, who decides that we have hit a crisis? Well, SEBI decides. And from that day, this fund can buy investment-grade corporate bonds from mutual funds who have a problem finding buyers. Only securities with less than 5 years of residual maturity and which are of investment grade will be bought. The long-term credit rating of the corporate bond will prevail over their short-term ratings. In normal circumstances, the CDMDF will invest only in, say, short-term government securities, treasury bills, tripartite repo on government securities, and guaranteed corporate bond repos with maturity not exceeding 7 days, basically safe paper. During normal times, the fund will charge an expense of just 15 basis points plus taxes. But in times of market stress, the charge goes up to 20 basis points plus taxes. Expenses normally would include brokerages and clearing charges. The CDMDF will disclose the net asset value by 9:30 p.m. on every business day, but in times of market dislocation, when it is holding a lot of corporate debt paper, the NAV should be announced by 11 p.m. on the business day. Now, besides the initial 2% contribution that debt mutual fund schemes make, they will also have to invest a corpus equivalent to 25 basis points of their assets under management in the units of the CDMDF. In times of stress, as defined by SEBI, of course, if a fund house decides to sell a corporate listed debt security to this fund, the CDMDF, only 90% of the consideration will be paid in cash to the mutual fund, and the rest will be paid in terms of units of the CDMDF. Now, these units will bear the first loss if that corporate paper, that security sold to the CDMDF causes a loss to the fund, to the CDMDF. Such units can be sold during the tenure of the scheme. Access to the fund shall be in proportion to the contribution made to the CDMDF by the mutual fund. So, debt mutual fund investors finally have at least one buyer of the last resort security for their investments in debt mutual funds, especially in times of stress.